MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Out here, it's a snowy Friday morning in Vancouver.
Yes, this would be our sixth snow incident, as they say. And, of course, why do we make such a big deal about it? Because snow in Vancouver is pretty rare. We only have 1 in 9 Christmases are white here. We usually have a green Christmas.
Yeah, or a gray Christmas, yeah.
Bob,
gray and wet. But at any rate...
as we like to say, you don't have to shovel rain.
Yes, that's true. And the markets they're still firm. Of course, what worked well for us last year was, financial history. Where if you've had one year that it looks like it's the ending of a wild speculation, which was what it was, then one can look for a liquidity problem in the fall. And this is what turned out. Of course, there were some items that we're covering. We had our friends of the bull market, which are, credit markets, yield spreads, and the curve, plus industrial commodities, and they were expected to be favorable out to around mid-year, and then change, and then because the speculation was so extensive, would have a liquidity problem in the fall. And then, again, using history, Jim, is that the clearing could have been in November of the problems in the markets, or as late as going into Christmas. It turns out it was as late as going into Christmas, with the major indexes sort of bottoming on the 24th. That was also when crude oil had come down, and it had given some technical signals, and you had very oversold in both the S&P and in crude oil at the same time, which we noted. So then the rebound, in this case, we've changed our package. They're no longer friends of the bull market, but they're friends of the rally, whereby the credit markets would improve and industrial commodities would improve. And both of these are happening, and probably out to around March. So what we're looking for now is on some of the lead items, maybe crude oil or copper to, get strong, and they have been. And also the big stock market itself to put on a pretty good rush, which we're getting. Gee whiz, the oversold, let's say the S&P, the oversold going into Christmas was huge on using the daily RSI. And then now it's come up a long ways. It's a big swing. So it's been a very good rally. And and then a number of indexes are that way. So what we look for now is kind of like, is it up at the right time? Yeah, it could rally into around March. Are there signs of speculation? Well, yeah, that's showing up on our charts. The sentiment numbers, momentum numbers. The other one was pattern, where we're getting a sequential sell. And I want to make a distinction here, like the daily RSI or the weekly RSI. that's a measure of momentum, and that measures how exciting it is either on the upside or on the downside. And then the other is a pattern whereby the ups and downs over a number of trailing weeks, you end up with what we call a sequential sell. And of course, at bottoms, you get the opposite, a sequential buy. So we now have a sequential sell, and it may take a number of weeks for this to top and complete. But the main thing is you've got momentum, sentiment, pattern, a number of things saying, hey, it's exciting enough where one should be taking some money off of the table.
We'll have more with Bob Hoye right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, what do you expect is going to happen with precious metals, starting with gold?
Well, we like the sector, and historically, gold is fascinating, but it's not fascinating all of the time, because in a bull market, which for the general stock market, actually it's been a raving bubble. But in looking at all of the bubbles in the past, all the way back to 1720, you take the price of gold and deflate it by dividing it by the rate of inflation in the CPI. And it tells a story, and the story is that when you're in a huge stock bubble, gold's real price goes down, which it has been doing actually since 2011. And the gold stocks then are, they're serious underperformers. Actually, they've been, since 2011, a disaster. But then what happens with gold is that as the great bubble is concluding, gold should have been, in real terms, completing a base, which it appears to be. It's been relatively unchanged since January 2017. So it's been basing as the financial markets went crazy. So then with the actual turn up in this indicator, which it's only meaningful about once a month when they come out with the CPI. And with an uptrend there, it reflects improving profit margins for gold miners. And also, for, like exploration properties, it enhances valuations there. So, the pattern has been that, gold mining doesn't do so well in a great financial mania where we have been, but it does do well in a post-bubble contraction when the real price goes up, profitability comes in, production increases, and despite the economists and central bankers hating gold, hey, it goes into the credit markets, it goes into the financial markets and starts to restore liquidity. So this is ahead of us, and of course the entry has been, like anything in a long bear market, it's difficult to get in at the bottom. But our indicators turned positive the 1st of November, And the advice was to accumulate on weakness, and there was a down dip into the middle of the month. And like the Hoye got down to 137. And I think the low when things got really hit hard in September was 132. And then it's been up to 187. So it's been a good rally, but we wouldn't chase rallies in this. It's still going to take more work and time before you get this really turned around and into a solid bull market. And of course, at some time, Jim, it'll end up with a highly speculative market, but that's ahead of us. And there have been some good moves within different individual stocks have had some very nice moves. So, but we wouldn't chase rallies, and but one could, buy a little on each of the dips. It's sort of the opposite to the big stock market, where an intermediate type trader would want to be selling the rallies, such as now, and whereas for all the years of the big bull market, the idea is to buy the dips, and of course we've had our springboard buy model that helps you get in when you want to buy the dips. And then we changed that a little so that what it now works for on, say, the S&P is advice on selling the rallies. So it becomes a bearish springboard. But then it flips around, goes the other way. So it'll work on the gold stocks on buying the dips. We will have some fairly confident signals when those opportunities appear. So, but mainly, Jim, on the gold's early stages of what could be a cyclical bull market.
Silver has hit $16. It hasn't been there for the longest time. If there is a big move, is silver going to be the rapid advancer?
Well, in an ordinary world, we've been for a long time, silver in a bull market for gold and silver, when the U.S. dollar is weak, silver, of course, outperforms gold. And it gets highly speculative. And this was the case in 2011. And what we'd found in the 1990s is that when you're on a good bull market for gold and silver, the moment silver stops outperforming gold, you're within 2 or 3 weeks of the top of the whole thing. And that was the case in 2011. And then the other thing we noticed is that when you take the momentum thing, the daily RSI, on the silver-gold ratio, which in a bull market, silver will be outperforming, so that goes up. And when the RSI in, I think it was April of 2011, it got up to 92, which was extraordinary because we found anything above 80 could be in dangerous territory. So, and the only time that speculation had been that intense was back in the peak going into January of 1980. And of course in 2011, when it got up to 92, we advised that was saying that the speculation is dangerous. But we thought that the bear market wouldn't be as bad as what followed 1980. But hey, Jim, any bear market is bad, particularly when it's in precious metals. So this then, we're looking for, and bottoms take a long time. It's tops, speculative blow-offs, they're very precise, it seems. And this one in bottoms often can be a lot of work. So it's going to take some time before one can say, hey, the new bull market has actually really started. As I said, we got long in the middle of November and are content with the position and would add to positions on weakness with our technical work.
We'll have more with Bob Hoye right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, what's going on in the world of crude?
Crude oil, yes. That one is really good because if you want the big picture on it, which we worked on in 2014, was that the revolution in production that we've seen in natural gas, for some reason or other, it was somewhat ahead of crude, with fracking and horizontal drilling, would eventually hit petroleum. So 2014 crude was around 105, and we put together. But the thing that was really interesting, Jim, was that the technological revolution has happened with other resources. One of the main ones was 1910 in copper, where the mining guys down at Bingham Canyon, which is just south of Salt Lake City, figured out how to mine an extremely large, low-grade porphyry copper system. Well, that was in 1910. And of course then that technical revolution was applied to similar deposits all around the world. So, and actually Bingham Canyon is still being mined all these decades later. So then that was the ability to mine a lower grade ore deposit. Then in the 1970s with Nevada and Carlin, Nevada, the gold mining guys learned how to mine large low-grade systems for gold. And then with the oil and gas, it was a technological revolution whereby they learned how to extract from hitherto difficult conditions. So that was all very obvious in 2014. So then copper, gold, or the base metal, hey, I'm all confused. But anyways, the petroleum products came down in price. Actually crashed down to 26 in the first part of 2016, and then rebounded out, and it had a seasonal high last year, later than usual. Actually, some time ago, you could look for a seasonal high for crude oil in late September, early October, and it was on October the 3rd at 77. And then we thought it would come down to the usual seasonal low, December, January, and we thought it would be a dismal low. Well, it wasn't quite as dismal, but it came down. So, but crude oil now up until around March. That's been our position. The oil stocks would recover as well. But this is it's a trading position. There are many institutions have been in the oil patch stocks for a very long time, and their main play was based upon a political disaster in the Middle East, and that then, of course, is going to make your gold stocks or your crude stocks, oil stocks, go up. But now, with the U.S. becoming the key producer, OPEC, in the Middle East, it doesn't matter so much. So even if there are, and there will continue to be, political disasters in the Middle East, it'll have less influence upon crude prices. And what we're now really more should be focusing on is the post-bubble world, whereby we have had a great financial bubble, and each of the 5 previous ones was followed by a long contraction when, as I've said, the real price of gold goes up. But I didn't include that with this, the real price of industrial commodities, we took copper from 1830, but the pattern is that the real price of industrial commodities is likely to go down in the post-bubble world. So mining people would be well advised to have, well, this was our advice, was to lighten up on copper and base metal exposure and get positioned in gold exposure. So history has been a wonderful guide.
And as we speak, we've just got the report from the National Energy Board approving the expansion of the Trans Mountain Pipeline.
They approved it. I didn't see that one, Jim. I'm pleased to hear that.
And of course, we have a provincial government that's been fighting it, and yet we have the Alberta government, also an NDP government, fighting for it.
Yeah.
Interesting political battle there. Plus the BC government in favor of liquefied natural gas. So on one side they approve fossil fuels, on the other they don't.
Well, when you had some months ago the Canada oil prices plunging so drastically relative to the U.S., I mean, it was something like down around $10. That plus the weakening U.S. price would really diminish revenues in the oil patch, which it has. It's been severe. But the other part of this was, and we noticed this, mentioned it about 6 months ago, that it would also seriously drop tax revenues to federal government and to provincial governments. And then it might, that was the other part I put in, Jim, it might take 6 months for these governments to realize that their oil revenues from the petroleum industry are seriously down, and then that would help them make up their minds to get some pipelines built. So this is good news today on that one, Jim. Thanks for it.
Bob, thank you so much for being on the show.
Well, good to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.